Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You are listening to Money on Tap, and it is good to have you here today. My name is Seth Krussman, joined once again with Ben Brayshaw and Dan Michelon. How are you guys doing today?
No, I'm doing pretty good. I'm just plugging through a lot of information I'm staring at in front of me here at our radio studio. But yeah, I'm doing good.
Yeah. Well, have you done your homework? I mean, you were given the assignment. Are you showing up to class prepared today, Ben?
I am definitely prepared. I see a lot of yellow highlighting on my stuff, Dan. See that? Look at all that stuff, man. I just got information galore, ready to pack it out.
No cliff notes here. Going for it all.
Oh yeah. You never used to do that, did you? Just like highlight through your information so the teacher thought that you were actually doing the work?
I did all the highlighting in the Cliff Note books.
You didn't buy the ones that were used and already highlighted?
Oh no, I definitely was. I enjoyed used books. Those made life a little bit easier.
Yeah, it's funny that you could source your greater used books with trying to go through them first and see which ones were highlighted the best.
Yeah.
Gosh, that brings me back. Folks, that's not what the show's about today. If you're just joining us for the first time, welcome to Money on Tap. This is going to be life-changing for you. That's my promise to you. And if you agree, call us at 855-226-8551 or info@yourmoneyontap.com. And even better, if you don't agree, give us a call and let us know what we can do to better serve you in the world of investing. We're going to talk about three-dimensional investing today. That's what we do here on Money on Tap at Brayshaw Financial Group. We're all financial planners with Brayshaw Financial Group. And we really focus on, kind of this three-legged stool approach, this three-dimensional investing here that takes a look at brokerage. We take a look at the universe of investing, and that includes insurance. That also includes fee-based planning, because you know what? Everything matters when it comes to you and your investing and your future and your retirement. That's what we're talking about here today. One of the biggest places that you can be an investor in. I mean, this is, coming from me. Take it for what it's worth. But we believe that real estate is one of those places that is absolutely a place that people need to be considering, if not already invested in, for their retirement. So with that, guess what? Is real estate over or beginning is the title of this show. And I cannot wait to get going down this road with you guys today. I think I did a pretty full intro there. I may have missed something, but before we launch this show, let's go ahead and take a minute for Money in the News.
All right, first up, this is coming to us from Fox Business. Is inflation cooling off? It depends where you live. So what this article does and points to is something I think that we're all experiencing, this higher increased inflation and the effects it's had on all of our wallets. But there's a regional aspect to that, and some places have felt it worse off than others. But the inflation remains high, although it's tailed off here a little bit. But price for everyday goods, including gasoline, groceries, and rent, rose 8.5% in July from a year ago, which is down from 9.1% in June. So you see a slight adjustment there. However, it remains significantly high for sure.
I think it's interesting as you're looking through the interest rate world. I mean, the Fed has made some difference in inflation in some levels, but when you actually start looking towards, like the Western states, the article references, they're actually still reporting inflation rising. Yeah. Which is, they're looking at everything. So, I thought that was interesting. So Texas, Oklahoma, Arkansas, Louisiana, they're reporting prices soared at 9.7% in July. And then Montana, Wyoming, Idaho, Nevada, Colorado, Arizona, New Mexico We're a close second, going up 9.6%, where the national average is 8.5%. So, I think, the Fed's seeing some response elsewhere, but a lot of this has to do, you look at some of these states, this is totally a political shift. People are moving to Texas from California. It's a fact. They're running out of U-Hauls.
Yeah.
So that has its own demand on inflation, which is completely, Fed resistant, I think.
Yeah, they reference the real estate aspect of that, particularly in those states, and they cite an example where, the average home in Phoenix, Arizona, was going for $435,000 in December, which is 28% higher than the previous year. So clearly, there's a flight to these states.
Yeah, it's huge.
Yeah, some of the other things that are pretty impressive along this line is also, kind of the Eastern Seaboard where you guys are at. Some of the states there that have kind of seen a cooling off of the prices as well, which you guys are getting to, receive the benefits of that. And and that's not so bad because those are really the most populous states, and that's typically the way that the numbers run is through the greater population.
I think these are actually kind of, I was looking at the New England states because obviously that's relevant. As soon as I saw New Hampshire, I was like, but it's just kind of bulked together at 7.3%. But, I was talking to a real estate guy the other day, and he was saying that New Hampshire, there's like no houses basically for sale. Like it is like there's nothing on the market. So they're still getting crazy amounts of offers, even with the interest rates where they're at and so forth. So New Hampshire is obviously probably the more conservative of the New England states. And so there is a flocking for that. People want to get out of the downtown city, Boston, out of the fear of the pandemic. There's that kind of find the rural. And what a lot of people don't realize is how small New England is. Like we can get to Boston in an hour, and so, so somebody who works in Boston doesn't necessarily have to live there. And so that's so different than, when you think about California to Texas. Those those two states are bigger than New England entirely. So individually entirely. So that creates, people don't understand. I always tell people, I'm like an hour outside of Boston. Like, what? You're in New Hampshire.
No, it's easy to get around. Everything is close. And, one of the things I found interesting here, and just kind of wrapping up that article, we talk about inflation rates a lot, and that's been a common topic here of discussion. And, year over year, we've talked about these rates, 7, 8, 9%, how they've increased. But what was an interesting statistic in here is that the real average hourly earnings have decreased by 0.5% in July, and on an annual basis down by 3%. So I think that's what's pointing to is that, because wages are up, but inflation's up, cost of living's up, what's the real impact on the pocketbook? And, when you factor in a little bit more money coming in, a lot more going out, but what that's telling, it's about a 3% net effect on your actual finances. Yeah,
and then it goes on to say, which I thought was a nice follow-up note, was that, gasoline prices down. They're still up, but they're down. But the amount down that they are, which is, it's relevant, but it's $400 million back into the household balance sheets.
Wow.
That's a phenomenal change. And that's obviously, when you think about people are getting paid potentially a little less than a year ago, well, expenses are now down again. So that's probably a wash.
So what is the price at your pump right now? Like where you typically grab your gas?
The best you can find is like $3.54, $3.55, something like that.
Yeah.
Wow.
Yeah.
That's almost worth it to me to drive to New Hampshire just to fill up and drive back again. Like
just to say you did it.
I was driving by the pump the other day, and it was like, oh, hey, look at that, $4.41 a gallon. Yeah. It's like I should probably stop there and get some of that. Like I don't care if it's
like a drug dealer driving by.
It's like it's the mindset has changed so much. I'm like, oh, can you believe that? That's an expensive gas right there. Look at that. It's only $4.30 a gallon.
I remember paying 76 cents a gallon in Virginia in college.
Gosh, yeah.
It was just
69 was the mark that I hit there.
Oh, so you guys had me beat. The first time I filled up, it was after school, though. It's the first time I had a car. It was after I'd gotten out of school. It was 99 cents. I'll never forget it, but 99 cents was the first tank I filled on my own in my own car kind of a thing.
Yeah, people used to just give you a buck. Hop in the car, everyone give you a buck.
Yeah. Pooling for gas money. All right.
long way from there.
Yeah.
Next up, we have U.S. travelers are getting bigger discounts in much of Europe amid favorable euro-dollar exchange rate. This is a great article. And I mean, for all of the retirees who are listening, I mean, the dollar's at its highest in roughly 2 decades relative to the euro. And the dollar is worth more than the euro. Like it was $1. It's 101 to 1, meaning it's, it hit parity and then it's continued moving. So, I mean, you can go to Europe and what used to be, 16% higher is now 16% cheaper. Yeah. It's pretty incredible. I mean, a lot of people who are looking to travel, this is an opportunity to do it at a significantly reduced rate. I mean, you can book your airlines, you can book your hotel, your rentals, your car rental. You could do all of that now and be planning for it, 6 or 9 months from now, even if the parity is lost and, the euro climbs back up. And I thought, that's pretty incredible. So what's really interesting, and I thought, the Fed is aggressively and the most aggressive interest rate hiker, right, in the globe right now. I mean, they are the ones taking the bull by the horns, as they say. And in the article, it says that the European Central Bank increased rates in July for the first time in 11 years. I was just absolutely floored by that. I mean, I don't watch Central Bank's interest rate management, but 11 years, more than a decade? They haven't even touched it.
No, it's incredible. And there's one of the things that they do reference in the article is that because of that rate hike, they expect this leveling off between the dollar and the euro. So it's kind of painting the picture that now's the time to strike. And even if you're not set to travel, they do reference that if you pay in advance,
right,
not only will you get the discounted exchange rate right now, but you can often get a discount from the airline, the hotel, the entertainer, wherever it is that you're going. If you're willing to pay them ahead of time, you can get a further break on your money there.
And there's a lot of people looking to travel after, COVID and the pandemic and being locked up, and they've had all these travel plans. It's like, it couldn't be a better financial opportunity than now.
Yeah, this is exceptional that the euro is down 16% from over a year ago, and that really does offer not only just an opportunity. I mean, that's a really cool, like, a consumer aspect to global financing. I mean, how often does that come into consideration or a topic on people's dinner table? Like, hey, maybe now's the time to travel to Europe because guess what? The dollar is super strong. And
or guess what? I heard it on Money on Tap.
Yeah. Well, here you go, folks. Here's your chance.
You get a lot of distribution calls.
This actually, some of the timing of the, like, some of the stuff that's in the article here, like since what was it, 2011, I think is the time zone that the oh gosh, what was it that you were saying, Ben, just a minute ago? Like, how long has it been since we've since they've raised rates? That's what you were talking about. And I was like, I did the math real quick, and I was like, oh, well, that was, gosh, over a decade ago. That was 2011, and that's hard to believe. Like, that was when the timing was, or when did the euro begin? It was 1999, and yeah, that was over 20 years ago. It's just time. I'm now in that place that I'm that guy that's like, wait a second, 20 years has already gone by. Yeah.
I remember since the establishment of the euro, there would be, we'd have family members and friends and people coming in from Europe and going on these huge shopping sprees. I mean, they would come over and just buy everything.
I know, right?
It was significantly cheaper, right? And then just ship it all back with them. Now the tables have turned,
I know. I think it's interesting. People would buy 10 sets of jeans, friends, family.
Clothing, like crazy.
Oh, it's ridiculous. Oh gosh.
Yeah, I think next show we should probably bring in a little bit of the opportunity here, like, what companies are really truly benefiting from this parity.
And there are a lot of them.
Yeah.
Yeah.
Oh my goodness. Well, guess what? Next up, Mr. Bezos. It's been a while since the name of Bezos, his gray star headlines, or Amazon, has been here with us. But yeah, you know what? We feel like it's a good opportunity for him to I don't know, plant his flag here with us for a minute. He's doing it. This is somebody that has a lot of money, if you didn't know that, and he's out there really betting on this housing side. Is the article that we're bringing to you. It's his single family rental play appears well timed. And this was from Dan Budzen. Thank you very much. August 30th. We now have an opportunity to bring in this side of the show.
Yeah, and what the investment he's made to try and take advantage of what's going on is in an investing platform called Arrived Homes, which is very interesting. What it'll allow you to do, you can participate with as little as $100 up to $10,000, but you buy a fractional share in a single-family house that's out there in the rental market. So you literally go to the website, you can pick out the property, and they have a whole slew of them there, the one that you may be most interested in, and you can make a small, at your discretion, investment in that house and then participate in the rental revenues as they come back through, which I thought was just a very interesting idea.
Yeah. Now, certainly it's not something that's this is not like a marketable security out there, folks. So, just buyer beware. This is, there's not a whole lot of recourse or any of that kind of stuff out there. And that's one of the things that gosh, there's just so many different investment opportunities out there that we just can't even really dive into on air here with you. But this would be one of those that's, it's interesting. And real estate is one of those places too that I will say, there's been a lot of people that have, they've been influenced into investing in real estate without really understanding what kind of real estate they're getting into and what their recourse is and what their exit strategy is or their exit options are. Real estate as a whole, it's, we're going to talk about it a little bit more here, but it's considered an illiquid investment. There are ways to be involved in real estate. We'll talk about that too, which is pretty exciting that, if you wake up tomorrow and you're like, that's just not the thing I want to do. Yeah. You can shift that gear too.
I look at this article and if I was an investor, I wouldn't put a penny in this thing. I look at it from a standpoint of I'm glad Jeff Bezos has the money to run with this and do it. And I think rents are going to be on the rise for a while. And I think there's some legitimacy to the overall investment strategy. But somebody who doesn't need liquidity and doesn't, and can park their money away for a long period of time and, in something that's, super high risk because it's even brand new. They don't even. So, there's a lot here that I would, buyer beware. Like I wouldn't put a penny in this thing. At some point in time, you're going to hold it longer than Jeff Bezos. He's going to get out of the perfect time and have sold his shares, and you're going to realize he's selling, and you're going to sell, and it's going to be lower than what he got or lower than what you put in. So these are the types of things that I run from. I generally look for very mature real estate programs. Like I look for things that, like if you want to throw $100 at this thing and so forth. I would just count it as $100 you're throwing away. And if it does it for you, great. And it sounds cool. Hey, I'm going to join with Jeff Bezos and invest with him. But honestly, there's a lot better ways, I think, to invest your funds. And I just think this thing, I long for the day when we read this article about this program and, how Jeff Bezos made a ton of money and everyone else lost it, because that's what I think is going to happen.
Yeah. Well, that's going to do it for us, Money in the News. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today, we are talking about is real estate over or just beginning? We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about, real estate. Is it over or is it just beginning? It's a part of investing that for us, I think it's really exciting. I think we all really enjoy the real estate conversation and looking at different ways that it can really either be a significant cornerstone or a valuable part of a retirement strategy or an income story. It's a segment of our investments out there that is just absolutely massive and undeniable when you take a look at the marketplace. And there's so many different ways to be involved in the real estate story. For starters, we're going to talk a little bit about, guess what? The home, the place where most everybody relates typically with real estate is that roof over their head. And if you haven't noticed over the last several years, the values of these things have really kind of gone up a little bit. And that's mostly across the U.S. And definitely there's parts of the U.S. that have seen an influx over the other. But what we've seen recently is a cooling off. And it's not everywhere. So it's definitely a large part of the U.S. that is still experiencing an influx or an increase in the real estate world. But overall, it's changed. And, a big part of that, as we take a look here, what's under the hood, it's interest rates. I don't know if I assume everybody's heard that the interest rates have gone up and we're all experiencing that as well. But what that has done in terms of the mortgages is, what was available a year ago, 2.85% is now closer to 5.3%. And that makes a big difference in the payment and the overall, what's affordable out there on the market, as well as the increase in the prices. So we're starting to see a pretty much across the board this cooling off. There's less competition in the market. People are actually able to finally negotiate if they're a buyer instead of just saying, "Oh yeah, no, I'll pay your $400,000 cash, no contingencies on this house." So it's a different world out there today, and we're going to talk a little bit about that first.
Yeah, no, I actually saw this morning mortgage rates on average were up to 5.89%, which is last year, a year ago, was 2.87. So it's doubled. And really what that's done is cool off the competition around homes. To your point, Seth, there was a period of time where houses, at least locally here, were going 10, 20% over ask and cash, no inspection, no contingency. And they were selling in a day or two. I mean, it really was crazy. And it remains, pretty hot. I haven't really seen it taper off completely in the sense that, houses are not sitting around on the market. The inventory remains slim. But the number of offers that people get on any given property seems to have kind of tapered off a little bit.
Yeah, I would agree. I mean, it's definitely been crazy. I mean, I think the Freddie Mac 30-year fixed mortgage average is about 5.22. So you seeing 5.89 doesn't surprise me at all. I think a year ago the average was 2.87. So I mean this is just crazy. I mean, this is a crazy jump for people who are traditional home buyers. But there's this other issue, which is all the cash that's on the table. Government's printed a ton of cash. They pushed it out in EIDL loans. They pushed it out in the PPP. There's all sorts of different ways. New Hampshire had the Main Street Fund. I mean, there's like 3 or 4 different ways you could have gotten money as an owner, business owner, all sorts of different things, which, most of America owns a small business. Like that's a kind of a trend of our world. And so, $10 trillion out, there's a lot of people who have cash to buy, and that's, that's created less dependency on the banks, which, is why has brought all of a sudden cash buyers everywhere. And the other thing is that people who have been hoarding cash or maybe wealthy who didn't want a home in New Hampshire, just were happy with their, condo in downtown Boston, said, "Hey, listen, you know what? I don't want to ever get stuck in this place for 3 months or 6 months or a year again. I want somewhere else to go." So vacation property is just astronomically grown, in New England for sure. And so that's been really interesting. I think, we were chatting about it earlier, talking about homes and stuff like that. I mean, I think New Hampshire has its kind of own little demographic from what I understand. And I think, Seth, as you said, things are different your way, and things are clearly significantly different down in Texas and Florida. I mean, there's just different drivers for all of these different pieces. The truth is some of these are inflation driven and some aren't. You can sell a house in California and buy 10 times the home in Texas, So there's some really interesting things going on in this world around us. And there's a shift of people. I mean, there's groups of people who are just shifting in and out of political realms, in Chicago, I know people that moved from Chicago out here. I know a couple people actually. So there's a lot inside this world that's, crashing, I think, in one respect because interest rates are going high and they can't afford a new home. They can't move anymore. It's out of range. But there's still this other group of people, which is still large, which is why, you're still averaging a significant number of, I think the last month's, average was 3.5 offers per home, down from 4.1 offers in June and 5.3 the month before. So, that whole kind of fluidity of, less offers, maybe you're not getting, 20% over asking, and so that's tapering this down pretty quickly. Those extra offers are from people who are probably looking for normal mortgages.
Yeah. And those are the people who, previously weren't getting considered, right? It's the cash buyer with no contingency is going to get the house. Now, some of those people potentially drying up, and that kind of opens up opportunity for your traditional home buyer. Right.
And now it's not an investment home buyer, right? It's you're buying,
live there.
You're going to live there, right? So, I mean, some of these people were just buying and moving them as investments. So I think from a standpoint of, you want to buy a house and you want to live there, and you think you're going to make 28% in a year, that day's over. I think that's what I would say.
Yeah, and that points back to the title of the show, right? Real estate, is it over or has it just begun? And, I think the answer is depends where you're looking, and that single family scooping up that, vacation / investment property, that's probably cooling off. But at the end of the day, we still do have a supply-demand issue, and people need homes.
In certain areas, like a flip house in Florida is going to sell quickly. A flip house maybe in New England's not.
Yeah. So the numbers around some of these areas I thought was kind of interesting. Like some of the greatest cooling off places have been your Phoenix, Austin, Nashville, Seattle, which a year ago, and even Riverside, California was in there. Like a year ago, if we were to be talking about these places, it would be, holy cow, have you seen the number of people that are moving in there? And so it's an interesting, supply and demand that can happen around any segment of the investment world, and this one particularly fueled by pandemic, cheap money, lots of money out there, and the influx in the investments themselves, the rate of return there for people that were seriously buyers, purely because of that investment opportunity, and to see things ebb and flow just like the rest of the investment world is what we're going to be talking about. It is definitely per area, right? Where Raleigh, North Carolina is still like one of the hottest places that people are buying right now, based off of the bidding war rate of around 63%, and some of those other areas that we discussed a minute ago are closer to 30%. So I'm curious to see how many people have some meaningful data out there and are either have the option of choosing where they live, and because of this data are now going to go ahead and start to shift their momentum into some of these areas where it's like there's the opportunity, or is it just purely going to be driven by kind of a demographic kind of a story where this is get in where you fit in. I know there's a lot of people that our friends, family, or clients that have moved into relocated into other areas because they felt like it was just a better fit for them, more like-minded people. And the pandemic was one of those things that really pulled out a whole lot of conversations. But man, I'm just thinking about Portland and our riots. That's why I was laughing there, folks, is because I'm on one extreme of that whole conversation with what we've got going on here. And it actually made me pull up some information on the greater state of Jefferson. If you've never heard of that, that's where pretty much the all of Oregon outside of Portland area and the Portland metro area has been voting towards, we don't want to be a part of Oregon anymore. Let's combine with Idaho and Northern California and, go towards that like-minded shift of we want to have something that's our own and doesn't identify with this ultra left over here, which is, that's where I live. That's where I'm at.
I think there's like three areas to invest, and I think that's what we're really kind of covering here. And Seth, you're dabbling in that on some level. And I think the flipper of the house, you may not be somebody who can flip a home. You may not be a person who's just going to buy and sell and make a bunch of money and can move easily. Like you've got a job or you're whatever. And I know people who sold their house in Florida and went to rent, and then the rent was actually more than their mortgage. And they were just using a portion of their gains to do that. So there's a lot of moving parts around, personalized real estate. And I think that's the over, Dan, that you were talking about. But there's like a couple other places to invest, which I think for me, one of these is very, very interesting. I find it curious because I know somebody who actually invested in this stuff, but the mobile home parks, I think this is the cost of inflation is driving people to the point where, they can't afford a 1 or 2 bedroom townhouse, whatever rental. It's $1,500, $2,000 a month, and these mobile home parks give them as much room, if not more, and a little bit of a yard, and they're paying a third of that. And I think that that's really interesting. And I thought it was doubly interesting that 22 million Americans live in mobile homes, which is about 6.7% of our total population. That's 1 in 15 people.
That was an incredible stat. When I saw that, I was surprised too. I mean, we see them, but I never thought they were so prevalent.
I was blown away by that. But it's just interesting that these super wealthy people of this world are just either they own these things or they're jumping into these things because of wealth taxes and all sorts of things. And I think there's a lot to be had here.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about real estate. Is it over? Is it just beginning? And there'll be more when we come right back.
Folks, we have a lot of fun doing this show, Money on Tap. And Ben and I have been financial planners for years and years, and our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space. And what we'd love to do is to open the doors to you with us at Brayshaw Financial Group so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Brayshaw Financial for complete wealth management.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about real estate. Is it over or just beginning? And it's really a fascinating segment of the investment world that a whole lot, not a whole lot of people dive into, but that mobile home park concept of it being an investment that has some stickiness to it. because of the way that they're set up. And one of the things that it was interesting to learn about in that is if you buy a mobile home in a mobile home park, it's going to cost you about $3,000 to $10,000 to move that from that park if that's what you so choose. So that kind of has some people that are in that mobile home are probably going to stay there until they sell it, or I don't know what else they do. But that's one of the things that's really attractive when taking a look at an investment is, are you going to continue to be able to count on those dollars coming through the door in the way that they are originally?
Yeah, I think what's interesting is I've never invested in a mobile home park. I say that to all investors. I don't think any of us have, right? But there's one that trades on the New York Stock Exchange. The ticker was ESL. It's owned by Sam Zell's Equity Lifestyle Properties.
It's ELS.
I'm sorry, ELS. Sorry, folks. And it owns 146,000 units across the U.S. and some in Canada. I mean, it's crazy. I mean, that's a ton. And then on top of it, you got Warren Buffett, who is nose deep in this thing. I mean, he's not only owns Clayton Homes, which is the largest manufacturer of mobile homes in the U.S., and then he has 21st Mortgage Corp and Vanderbilt Mortgage, which is the biggest mobile home lender.
Yeah, he's in on every end of this market. That's for sure.
I'm like, he's no fool. So I was very, very interested. And then to come to find out that, Dan, you brought this to my attention, but I thought that was pretty amazing, was the cap rate on these things are around 9%. I mean, that's
unbelievable.
That's incredible.
That's incredible. And considering the stickiness, I mean, some of these homes might be 30 or 40 or 50 grand. I mean, we're talking top end to be that high. To move the thing is $10,000. I mean, you're not going to, at that point in time, you're upgrading your home. That's why they sell them in place. So it's not like they're going. And people are paying so little for this kind of space of land that they're getting to use. That's what they're renting, is the land. And the ability to raise rents on these things is pretty astronomical. I mean, the agreements these people sign are probably obnoxiously in the favor of the owners of these properties.
Yeah, when you just factor in kind of the presumed, lower income status of a lot of people who choose to live there, the likelihood of them being able to afford the get up and go. Seth, you mentioned it, $10,000 to pick up and move your home.
Yeah,
they're not going to do that. So you're going to pay subtle 3%, 4%, 5% annual increases. They're going to pay it.
They'll pay a 10% annual increase.
Yeah,
you know what I mean. It's so much cheaper. It's like, okay, well, I'm going to pay $600 more a year, or I'm going to pay $10,000 to move my place.
Yeah, those people are pretty well locked in there.
Yeah, it's a very, very interesting area to invest.
Yeah, there's actually something that people may not consider, because when I think of a mobile home park, I've kind of got this like idea, the one that's on my way to the grocery store that I see that I'm like, oh wow, hey, look at that, there's that mobile home park, and that's what I think of mobile home parks. But there's actually there's quite a bit of diversification in this sector, and one of the things I did not realize is that Texas is actually the mobile home park capital of the United States, with 5,176 mobile home parks. And I bet you can get quite a good deal on a mobile home park there, but with probably some more property even. But the diversity there's mobile home parks that cater towards the 55 and older crowd, that have quite a community involved with them. So there's some other things that can be really attractive here. I've seen mobile home parks that have, like, think of the apartment complex that has the facilities, the pool, the rec room, all these things, but it's
on the ocean. I mean, there's a ton of these things that are super expensive. They're on the ocean and they're gorgeous.
I was just thinking the only one I've really known and seen on a regular basis is there's one in York Beach, Maine, where I go to every summer.
Yeah,
and it's at the end of the beach, literally directly across the street from the beach, up on high ground. I mean, it's beautiful. It's absolutely beautiful.
It's pretty.
I've even heard
incredible.
There's some really nice ones on Winnipesaukee. Am I right?
Probably.
I'm sorry, folks. That was my. I wasn't serious.
Well, the thing is like, this is, just because you're talking about 22% of America live in a mobile home. So there's a very, there's people who are just living in lower income, and this is an affordable way for them to own their own place, and it's a great opportunity. These places, are like Taj Mahals sometimes when you walk inside, and it's just super affordable. And with inflation going, I see the world moving more in this direction. I see more demand of these things being something that's, really opportunistic. I also see more of a demand in this space with the baby boomer retirement, because there's a lot of places people want to have a second place, but they don't want to pay a couple grand a month on a mortgage in Florida or whatever it's going to be. They much rather, pay $50,000 for a beautiful mobile home and, some really nice location that's near their family and children, and pay $500 or $600 a month. It's so much cheaper.
Yeah, single story living as they're aging,
Yeah.
in and out, nothing to maintain.
80 million Americans getting ready to retire on top of the 40 million that already are. Listen, there's going to be a boom in this space, and I think this demand, because of inflation and the baby boomers, this is a great investment option. I think. I don't know whether that particular investment, on that thing we were reading, I just was kind of like, wow, I didn't realize it was so mainstream in that. And I mean, we invest in stocks every day. I had no idea. So there's no recommendation in that particular investment, but I do think there's some real opportunity here if you can find the right investment at the right entry point with a decent yield. I mean, there could be some options.
Yeah. And you don't necessarily have to be the investor that's coming to the table buying the manufacturing home facilities or the manufacturing home manufacturers themselves, and then becoming the lender. I mean, I've known some investors that's how they've aligned themselves really vertically in this market. They own the park, they own the manufacturing home manufacturer, they own the debt on the manufacturing homes, or they facilitate the financing, and it can be extremely profitable. But there's groups out there like the you've already mentioned, the Carlyle Group and Brookfield and Blackstone, Apollo. These are these large private equity firms that have exposure in these spaces. That's probably not the option that you're going to have as an investor to be a part of. If you are, that's great. We love that as well. We're going to get here in just a couple of minutes how you, as just an investor, can participate in different segments of the real estate world without necessarily having to own the mortgage, the paper, and all the rest of that jazz. It's going to be a lot of fun. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Everybody has exposure to real estate, believe it or not, and it's going to be really fun for us to dive into some of the opportunities that people just are not aware. People just think of real estate as, well, it's the house I live in, the house I buy, or if I want to be an investor in real estate, then I need to go and buy a duplex or a fourplex or just another rental home, and that's the only real avenue that people have to get started in their real estate investing. And the fact is that's just not true. To do that, which we're big believers, I think here, all of us here at Brayshaw Financial Group are big believers in real estate being a part of the story of wealth, the story of investing, and for the most part, the story of retirement, how to create income, because that's so critical for our retirees, is how to create income, consistent as well as growing income over time to keep up with that pesky inflation, folks. So one of the things that if you're not a roll up your sleeves and change out the toilets and figure out your next renter situation, investor in real estate, is to take a look at this marketplace. Yes, the market has real estate.
Seth, it's a lot of people don't realize that, hey, I can buy investment real estate in the stock market. There's traded REITs, as we call them, real estate investment trusts, and there's a lot to them. And I would just caution everybody that when we're talking about real estate is the high risk level, right? So anything you're looking at in real estate, it's high risk. You buy a house, it's high risk. You don't have any idea what's going to happen. The pandemic is, for example, no one ever thought Boston was going to crash in its real estate, but people were buying condos in Boston for pennies on the dollar. It was crazy when that was happening. I know a guy who actually took advantage of that. And, some of the real estate programs we're going to talk today, just example risk, and these are well-known companies. Some of these have seen in the last 4 to 6 months anywhere from a 20 to 40% drop in value in their share price. And I think, so when we're talking about real estate, I want people to be really, aware of there's entry points and there's exit points, and there's times when you hold things and you just keep them. And Dan, you and I, we had that conversation about Johnson & Johnson and, how, I can't remember what the average yield was historically, but you really couldn't have really timed buying or selling Johnson & Johnson other than just holding it.
Right.
It was just kind of crazy. And I think real estate is one of those things, but you can potentially, get better entry points. And I think that's one of the things, we were digging through, looking for information on REITs and trying to get, we do a ton of business in real estate programs. So, a lot of it's just on the tip of our tongue, but, kind of going through it, it's just like there's, 5 REITs that in the last 4 months have hit, new lows for the last 52 weeks. It's crazy. It's just unbelievable. People have just sold out of real estate programs left and right. So there's a lot to real estate and getting invested, but some of these programs, they're large cap holdings. They're well diversified, both, based on the types of real estate they own, whether it's office or, industrial or residential. They're geographically diversified. There's ways to find strong, pretty good, programs that can get you the kind of diversification that you may not see as many swings and so forth. But with all that's going on with interest rates and everything else, obviously these things are just dropping. But it doesn't mean that the underlying real estate's not owned by the REIT. It doesn't mean that it doesn't have occupants in the REIT. It just means that people took profits from the stock and sold it, and sold a lot of it. And so I think that's really interesting. One of the 5 that hit all-time lows was Welltower, and I thought that was interesting. It's low of $75.80 from its peak of $98 in April. That's a 22% drop in 4 months. I just think that's crazy. But here, this is a big healthcare facilities REIT. So I personally believe healthcare is here for the life of human population, and so there's some
for the life of human population.
Yeah,
I just want to pause there for a minute.
Yeah, seriously, I don't know. I was trying to figure out how to say that, but
it's okay. You got it.
There's clearly a need for this real estate, right? We know, and with baby boomers, there's probably an upward tick of demand. We see hospitals constantly putting additions on, right? So, here's some great opportunity from that.
Yeah, another one that's suffered a lot lately, and the primary driver in these things is probably interest rates. These REITs are all very sensitive to that. But Boston Properties, it's BXP. They're probably the largest office space owner in downtown Boston, and they've dropped 40% since March.
Since March?
Since March. But it's still paying, kind of pointing back to the J&J story, it's still paying a 4.9% yield, right?
Yeah.
So as an entry point, you think it's going to recover to where it was, and there's no guarantee of that ever happening, of course. But
still could go down.
It still could go down from here, but it's feasible. It's I hesitate to say likely, but it's possible it could get back there. It's been there. So you could see the value of your investment appreciate 40% between now and whenever that day comes. But in the meantime, you're still making 4.9% on your money.
Yeah, and I think the thing is that there's somebody out there that's suffering a 40% loss of their money.
Yeah.
Collecting a dividend that's lower than this, but
there's 2 ends of every trade.
Right, and 2 ends of every trade. But I think that's really interesting. So for people who are using Monte Carlo theory, and if you don't know what that is, you can give us a call at 855-226-8551. But using Monte Carlo and trying to make sure their money lasts their lifetime, and using anywhere from 3 to 5% as a distribution rate, here's something that's 4.9. So that's the distribution rate as long as they don't change the distribution itself. That's what you're going to get. So there's a real opportunity there to create some active income for an investor. I think that's important. Another one, Dan, Kilroy Realty. This trades about 800,000 shares a day in its volume, but that had a 38% drop from 78 to 47. That pays a 4.34% dividend. Independence Realty Trust. This all came from Yahoo. They're pointing these things out. That hit a low of 1901, which is down 32% from its $28 high, paying a 2.88% dividend. Now, that trades a volume of about 2 million shares, so much more actively traded, and so there's some more activity around that, and I think that's interesting. And, you're looking at these companies and you're basically saying to yourself, what makes sense for me because there's yield, and yield is not the reason to buy any investment, right? The actual dividend you're getting is not a purpose for buying it because there's different reasons. Companies could be paying down debt or whatever and pushing out less income, which might be bringing value to the asset alone. You have to understand kind of the overall concept of that.
Yeah, and that's why getting into a publicly traded REIT might be in your interest as opposed to a private REIT, simply because if the company does change its management style or its dividend philosophy, whatever it is that comes out of favor with the reason you chose to invest there, you can get out of it very quickly. So you can just trade it like a stock on the market as opposed to if you're in a private REIT, the exit can be significantly harder to achieve.
Yeah, absolutely.
Yeah, some of the things that I was just taking a look at the charts because that's it's that's kind of what we have as far as the history here is we're talking about an asset class. It's going to ebb and flow. It's got its own reasons for going up, for going down. The rate, what the Feds have been talking about on the rates and the rate hikes and everything involved there has caused a significant volatility in this segment of the market. The rest of the market is included as well. If you were to take a look at that well, though. If you were an investor in this, pre-pandemic, you're at about the same level. You're still achieving the same results. If you were to invest in it post-pandemic, then you've probably had significant gains. And taking profit and having an exit strategy is all part of what you want to be aware of, whether you're in the long-term, long haul of an investment like real estate, or if you're a short-term kind of a trader as well. So it's a really fascinating part to participate in this way.
Yeah, and you talk about taking gains. I mean, I'm looking at one of the other REITs that they had mentioned. We had sold that REIT out of our managed portfolio a number of months ago. So it's like here these things have dropped, and I'm saying to myself, hey, you know what? It might be time to pick one up again. But the thing that's interesting to me about real estate, and this is the buyer beware piece, is I was reading through a number of different pieces. There's so many of these real estate programs that are still high level, short interests, meaning people are betting against these programs, So two things. One, either these things are going farther down, buyer beware, or if these short sellers are actually have to start covering, this could launch these things back up because they have to start buying back the shares they already sold at a particular previous value. So there's kind of some interesting headwinds here that are going to send this thing one direction or another. And I think that's the interesting piece. So if you're comfortable with a dividend, you think there's a long-term play here, and you don't have real estate in your portfolio, I'm not recommending any of these particularly, but I would encourage you to consider real estate as a play, for dividends that most of them even pay monthly, which is great.
Yeah, and that was another aspect of real estate that we were going to dive into here. It's typically with a stock, you get your dividend paid quarterly, whereas in real estate, you can get it as often as monthly, which for trying to build a predictable income flow, whether you're in retirement or for some other purpose, that monthly scheduled dividend can be a real saving grace. And one of the REITs that does that was highlighted here that I thought was pretty interesting is SLG, which they fashioned themselves the biggest owner of office real estate in New York City, which like the Boston one, right? So you think these major cities, pandemic or not, working from home or not, these spaces will fill and people will do business there, you think. But that particular one, SLG, is paying a dividend yield of 7.88, which is 31 cents per share monthly, which that's a pretty strong income rate.
Does it talk about how much short it is on that?
This one does not.
Yeah, so that's what
no, it does 10%.
10% short. So that's another swinger. It's either going down or it's going up.
People are betting against it.
People are betting that thing's going to sink. So I mean, it's interesting. I'm not a big better against New York City. I think post-pandemic, this thing eventually recovers. But
sure, I agree.
One of the things I wanted to mention before we leave here today is that we do have seminars available for you to become more educated on things that are specific to you and your retirement. Primarily, right now, it's important for you to understand negative sequence of returns. If you are entering into that retirement corridor, there is first of all, go to BrayshawFinancial.com. Take a look at the video there on negative sequence of returns, and then give us a call at 855-226-8551, and you can join into one of our many seminars that we have specifically tailored for you to understand how negative sequence of returns affects you and your retirement spending, and your ability to retire. It is significant, and we welcome the opportunity to work with you and spend some time talking about this specifically and how it affects you. Again, give us a call at 855-226-8551 or info@yourmoneyontap.com. Make it a great week, folks.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.